Welcome to the deep dive. Wow, what a week. I mean, this past week just delivered a remarkable sequence of events in the economic world.
It really did, a cascade of crucial data, and you could almost feel market sentiment swinging pretty dramatically.
Yeah, definitely left people rethinking things. So our mission today is to take a deep dive into the most important insights from all that news, specifically looking at Tuesday, July 29th through today, Monday, August 4th, 2025.
Right. The goal is to really equip you with the understanding, maybe some surprising facts you might have missed, whether you're prepping for an interview, just catching up, or, just curious.
Exactly, to be truly well-informed beyond the headlines. And at the heart of it all, our theme today. The jobs report bombshell may force the Fed's hand.
Because what looked like maybe a straightforward jobs report on the surface,
Yeah.
it hid some genuinely astonishing details.
And that led pretty quickly to that classic bad news is good news situation in the markets. Okay, so let's unpack this. Last week was, unusually heavy on the news front, wasn't it? All leading up to Friday's game changer.
It really started building early. We got that first estimate for Q2 GDP.
Right. Came in stronger than expected, positive 3.0%, which was quite a bounce back from that negative 0.5% the quarter before.
Yeah, the headline looks strong. But here's the interesting part. When you peel back the layers, a lot of that bounce, it was actually down to a big drop in imports.
Okay. So that can technically boost GDP, but doesn't necessarily mean the domestic economy is booming.
Exactly. It creates a bit of a mirage, you could say. And personal consumption, which, the Fed watches really closely for economic health, that was actually weak. Again, for the second quarter in a row.
Okay, so GDP, strong headline, weak consumption underneath. And then, speaking of the Fed, we got the PCE price index on Thursday, their preferred inflation measure.
Personal consumption expenditures, that came in at plus 0.3% for the month. Right on expectations.
Okay, so no surprise there, but
Yep.
Here was a wrinkle, wasn't there?
There was. The prior month's number, it got revised up from 0.1% to 0.2%.
Seems small, but what did that do year over year?
Well, that little nudge pushed the year-over-year increase to 2.6%, just a hair above the 2.5% expected.
So, okay, inflation may be a touch stickier than hoped because of that revision. How does the Fed balance that against other signals, like the ISM number?
Right, the ISM Manufacturing Index, that came in at 48%. Worse than expected, definitely indicating contraction in manufacturing.
Which normally would be pretty big news itself.
Absolutely. But this week, it was completely overshadowed by what came later, by Friday.
The jobs report. The biggest surprise, really.
Absolutely.
Okay, so the headline jobs added figure, just 73,000.
Yeah, a huge miss compared to the 105,000 expected.
Yeah.
And maybe even more concerning, the number for the month before that got revised down, way down, to just 14,000.
Wow, okay. But the unemployment rate, that actually met expectations at 4.2%, just up slightly from 4.1.
It did meet expectations, yes. But connecting this to the bigger picture, both these releases, GDP and jobs, they were actually quite a bit weaker than the headline numbers made them seem.
So why is that? What was buried in that jobs report?
Well, the really astonishing part, the huge downward revision. They revised the prior 2 months job numbers down by a combined 258,000 jobs.
258,000, that's massive.
It is. To put it in perspective, if you exclude the crazy numbers during the 2020 pandemic, these were the biggest downward revisions we've seen since at least 1979.
Incredible. And it had immediate consequences, didn't it? I mean, very public ones.
Yes, the president fired the BLS commissioner, Erica McIntyre. Very unusual, very direct fallout from an economic report. It really highlights the pressure, the scrutiny on these numbers.
Absolutely. And what does this do to the overall jobs picture for this year?
Well, it pulls the 2025 average for jobs added way down. It's now just 85,000 per month. Compare that to 168,000 for 2024.
So nearly a 50% drop in the pace of job growth. That raises some serious questions about the economy's strength, doesn't it?
It certainly does. And even that 4.2% unemployment rate, it was weaker than it looked on the surface.
How so?
Because the participation rate dropped. That's the share of people actually working or looking for work. It fell to 62.2%, missing expectations. So fewer people were even in the labor force.
Okay, so the labor market is showing some pretty unexpected softness. What are people saying about why? Why aren't firms hiring?
Well, we're seeing kind of two main theories bubbling up in the headlines right now.
Okay, what's theory number one?
Tariffs. The idea is that businesses are basically hitting pause on hiring. They're waiting to see what happens, waiting for clearer guidance on trade policy and tariffs.
Right. And last week was kind of a mixed bag on that front, wasn't it? Some new agreements, some extensions, but also more confusing comments from President Trump. And there's that court case challenging his authority, too.
Exactly. Still a very uncertain picture. There was a great quote from Steve Sosnick over at Interactive Brokers.
Oh, yeah. What'd he say?
He said, the market had sort of put tariffs in the rearview mirror and assumed that the labor market was okay. Well, both of those assumptions have been overturned quite dramatically.
Mm-hmm. Puts it pretty bluntly. Okay, so tariffs is one theory. What's the other?
The second theory involves AI, artificial intelligence.
Ah, okay. How does that fit in?
The idea is that some big companies, especially in tech, are actually cutting back on bringing in new people. Instead, they're pushing their current managers to figure out how to use AI to get more done, to boost productivity with the staff they already have.
Interesting. So using AI as a substitute for new hires, essentially.
Potentially, yeah. Or at least a reason to hold off on hiring while they explore that.
Okay, so we have this backdrop. Economic uncertainty, a shocker jobs report, these theories about tariffs and AI. How did the Fed react amidst all this? They had their meeting on Wednesday.
They did. And they decided to hold interest rates steady. That's the fifth meeting in a row with no change.
But there's something unusual about that decision, too, wasn't there?
Very unusual. 2 Fed governors dissented. They've voted against holding rates steady, presumably wanting a cut.
2 dissents? Has that happened recently?
Not like this. It's the first time 2 governors have dissented on a monetary policy decision in more than 3 decades.
Wow. So what does that signal about what's going on inside the Fed?
Well, it clearly suggests there's some significant disagreement about the right path forward, maybe growing concern among some members about the economic slowdown. And then adding to that,
Yes.
we also got news that Governor Adriana Kugler announced she's retiring, effective August 8th.
Okay, so that opens up a seed.
It does. And it gives President Trump an opportunity to appoint someone new, potentially someone more aligned with a more dovish stance, someone more inclined to cut rates, which could shift the internal balance even further.
Mm-hmm. Right. And speaking of rate cuts, that weak jobs report, it had a huge impact on market expectations, didn't it?
Oh, massive. Just look at the probability of a rate cut in September. Last Monday, the market priced in about a 6% chance.
Okay, pretty low.
As of today, it's 94%.
94, that's an incredible swing in just a week.
Huge. And looking out for the rest of 2025. Now, there's a solid majority, 92%, expecting cuts of 50 basis points or more, 0.5% or more. Last week, that number was only 63%.
So the market is now firmly convinced the Fed has to cut, likely starting soon, because of that jobs report.
That seems to be the overwhelming message, yes.
Okay, let's pivot to the markets themselves. How did they digest all this? U.S. stocks obviously reacting to the jobs report on Friday.
Yeah, they took a hit Friday, down about 1.6%, a clear negative reaction to that weak data.
But then, what happened today, Monday?
That's where it gets interesting. The market recovered a lot of that loss, up about 1.5% today.
Ah, so there it is. The classic bad news is good news switch.
Exactly. The focus clearly shifted. Away from, recession risk, towards, okay, the Fed's definitely going to cut rates now.
And we're also right in the thick of earnings season. We had some big names report last week, right, for the Magnificent Seven.
We did. Meta and Microsoft reported.
And the reaction there.
Very positive. Meta was up, 11.2%. Microsoft up 4%. Strong reactions.
Okay, but then Amazon and Apple also reported. How did they fare?
Less enthusiastic responses there. Amazon was actually down 8.3%, Apple down 2.5%.
But didn't all 4 of them beat expectations on earnings and revenue?
They did, yeah.
Yeah.
Materially beat on both the top and bottom lines, actually, which suggests investors are they're looking deeper now, parsing the results at a much more granular level.
So what's the underlying message they're looking for then, if it's not just the headline beats?
Well, the key theme coming through again is AI. Its impact. It's not necessarily about seeing a specific AI revenue line on the income statement yet. It's more about how using AI is maybe leading to higher overall revenues than expected, or perhaps driving better profit margins through efficiency. That seems to be the critical component investors are focused on for future growth.
Got it. Okay. And how did different segments of the market perform overall last week, given that jobs report?
Well, as you might expect, with weak economic news potentially signaling a slowdown, the more cyclical, higher beta parts of the market underperformed.
So the ones more sensitive to economic swings.
Exactly. Large cap stocks overall were down 0.9% for the week. Small caps got hit harder, down 2.2%.
And growth versus value.
Growth held up a bit better, down only 0.3%, likely helped by some of those tech earnings. But value stocks were down 1.8%. The Nasdaq Composite was down 0.6%.
Okay. And how about international markets?
They pretty much tracked the U.S. developed market stocks down 1.2%. Emerging market stocks also down 1.0%. They largely sold off along with the U.S. after that jobs report.
Makes sense. And bonds. With weak economic news, you'd expect bonds to rally, right?
Absolutely. And they did, a strong rally. The yield on the 10-year Treasury note fell quite significantly, 22 basis points.
22 basis points. So that's 0.22%. Where did it end up?
Closed the week at 4.2%, which is its lowest level since late April.
Okay. So a lot of moving pieces. Let's try and tie it all together. What does this all mean for you, our listener, whether you're heading into an interview or just trying to make sense of the fire hose of news?
Yeah, I think it really highlights how interconnected everything is. GDP, inflation, jobs, how the Fed reacts, how corporate earnings feed in. It paints a really complex picture. And understanding it demands looking deeper than just the headlines.
Like seeing the mirage in that strong GDP number you mentioned earlier.
Exactly. Or understanding why those jobs report revisions were so significant, why they completely shifted market sentiment and Fed expectations almost overnight. It's that level of insight, seeing beyond the surface numbers, that really helps you grasp what's driving things. It makes you much more informed than just, reading a quick news alert.
Right.